Hi everyone, I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, I'm happy to be joined by Chris Grisanti, MAI's Chief Equity Strategist, who's here to share his insights on what's been a difficult market environment in 2022. Chris, thanks so much for joining me today.
Sure, John. It's good to be with you again.
Well, Chris, the S&P 500 over the last couple of weeks has dipped back into bear market territory, down a little over 20%. And you've been right on that this year would be a challenging year for investors, given that the Fed was turning from the market's friend to the market's foe. The question is, do you think they've gone too far?
Yeah, well, it's funny. At the beginning of the year, I would write that last year the market and the Fed were best friends, and this year the Fed's not returning calls. But it's actually gotten worse. Now the Fed picks up the phone, yells at you, and hangs back up. So it's just a real tough spot. We're seeing interest rates go up the most that they really have to fight inflation in probably a generation. So the problem is, though, that the Fed was so accommodative and, at least in my opinion, too dovish for too long. And now they feel like they really have to make up for kind of a late start. So in some sense, the Federal Reserve's charge, like any central bank, is a bit of performance art. Not only do they have to be tough on inflation, but they have to appear to be tough in inflation. And that's doubly tough once you're a little late to the game. So I think there's a better than even chance that the economy will fall into a recession if it hasn't indeed done so already. In fact, I'm calling it a recession by design. And it's because the Fed needs to engineer an economic slowdown to stop this, fastest growing inflation in 40 years. Now, having said that, John, I actually think the Fed is doing the right thing. Once inflation is ingrained, it's an even worse problem than an equity bear market. It can last for years and years. It can erode purchasing power of all sorts of folks for the economy. So it's really quite difficult. So I don't think they've gone too far for their purposes. Unfortunately, their purpose is not to make money in the equity markets, which is our purpose. So the problem is, from where you and I are sitting, I believe we're in for some continued volatility at the very least. And don't fight the Fed is a saying for a reason. It's more difficult to make money as interest rates are rising.
Well, turning to this just dynamic between economic performance and market performance, you think about the economy this year, and I think we'd say it's held up fairly well. Certainly, we haven't had great GDP growth, but we do have a full employment economy, and the market's been terrible. So as you think forward to 2023, where you're now anticipating this recession by design, do you think we could have the reverse performance for the market in 2023, even though the economy is weak?
Yeah, John, you raise a really good point, because most investors kind of think the economy and the market is the same. And that's because they do clearly feed off each other. And in fact, it's hard to imagine a recession without a bad stock market. Having said that, the timing is often quite different. The market anticipates the economy by about 6 to 9 months usually. So it's not surprising, if we're going into recession, that the market has already dropped quite a bit. And in fact, in the average recession since the end of World War II, the market drops about 29%. And at its low point last week, the market was down almost 24%. So we're most of the way there to an average recession. Now, who knows? There's a lot of variation between things. But the other important thing is, it's not just the market is not a monolith. It's not a lockstep thing. So different stocks go down before, after other stocks. Different sectors, different industries can bottom before others. So we're spending a lot of time now in the equity department researching what's starting to look interesting, even though the market as a whole may not yet have bottomed. Also, I'd point out another thing, which I think is kind of interesting. So the recession in 2020 was caused by the pandemic. The recession in 2008 was caused by the global financial crisis. In both of those cases, the Federal Reserve, like everybody else, was running to catch up. They had lost control of circumstances, and especially in the global financial crisis, they were desperately trying to get things from imploding. Here, it's very different. The Fed is actually causing the slowdown on purpose because it wants to stop inflation. So if they feel that the pain has reached a point of diminishing returns, in other words, inflation's gone down, but more and more people are starting to lose their jobs, prices are rolling over, housing is starting to feel it, they can turn the dial the other way. And let me tell you, you don't have to be a lifelong investor to intuitively feel you want to be fully invested before they make that decision to take their foot off the gas, because that's when the pent-up strength of the equity market will, I would think, really reveal itself.
Maybe a little bit of hope there for
Maybe.
investors. And I want to maybe stay with that train of thought because, as you know, the vast majority of clients of MAI own equities to some extent. And they're probably hearing that, we think we're going into a recession and saying, why am I in equities at all? If that's the outlook. But maybe you can speak to those clients that own equities. Why should they continue to own them even when the outlook looks so bleak in the near term?
Sure. And I'm only half kidding when I say the bleaker, the better in terms of finding great opportunities. I mean, that this is when you build the portfolio for the next decade. So look, everyone loves a bull market. We all make money, and even if you picked the wrong investments, the rising market generally can make up for a lot of sins. But it's a bear market that creates opportunity, not a bull market. I remembered in 2009 when you could buy at the bottom in the global financial crisis, you could buy great bank stocks like JP Morgan at less than book value, or a stock like Apple for less than 12 times earnings. So in retrospect, you look back and say, wow, that was a no-brainer. But believe me, at that moment, it was not a no-brainer. It was difficult to commit capital. Things looked absolutely bleak, frankly, much bleaker than they look now. I'd say one thing in closing, as a rule of thumb to everybody listening, sophisticated investors and folks that are not quite as sophisticated, don't try to pick the bottom. What you want to do now is look at a potential investment and say, I strongly believe that 3 to 5 years from now, at this current entry price, I will make an above average, a superior return. Could it go down over the next 6 to 9 months? Sure. But are you investing at a great price? If you're confident of that, then I think you should go ahead. And again, this is the moment where you build the portfolio for the next upcycle. So we're looking forward to that.
Well, that's a great place to leave off because we do know that the end of the cycle gives birth to a new cycle, and we want to make sure that our clients are well positioned for the eventual recovery. So, Chris, thanks so much for your insights today. And to our clients, thank you so much for listening in. As always, at MAI, we continue to work very hard to identify opportunities to tilt your portfolio to what we see as the best risk-adjusted return opportunities available in the market, all the while staying true to the long-term strategic allocation that we have built uniquely for you to meet your long-term goals. If you have questions specific to your portfolio, please reach out to your wealth manager at any time. And as always, we thank you for the confidence that you've placed in us. And we look forward to seeing you again on the next edition of the MAI Market Update.